Good afternoon, everyone. It's Ted Bader here, president of SIA Wealth, and we wanted to take this opportunity to give you a bit of an overview of what we're seeing here at SIA Charts. It's a bit of a crazy day today on the markets and globally, so we thought it was a good time to give you a bit of insight from what we're seeing, and not only what we're seeing, what we have done in some of the funds, and kind of give you a bit of an update on where some of the SIA strategies might fit. I'll give you a little personal anecdote. I'm actually over in Europe. I haven't had a chance to make it back to Canada, and the situation has escalated pretty intensely over the last few days. But I'm hoping to get home tomorrow, fingers crossed, before everything really starts to shut down. So that's one of the reasons why we put that first slide out, what now? And that's a question I'm hearing a lot from a lot of clients is what now? Are things going to get better? Are things going to get worse? What's going to happen? And if we don't know what's going to happen, how can we anticipate and prepare and plan for the future? So what we wanted to stress today is, with so much uncertainty in the markets and emotions obviously running high, what is an advisor to do? How do you present that bastion of calm to your clients and explain what you think is the right opportunity forward, or the right way forward? So what we wanted to do is use this opportunity, again, to bring it back to what we're trying to talk about at SIA, is a very rules-based and process-driven strategy, just to focus on the unemotional aspect of money flow, regardless of it's into the markets or out of the markets, and be able to play accordingly and understand accordingly what your reactions and responses are. So it's been a crazy week. We've gone in the last 10 days from green to yellow to red. And we've subsequently sold most of our equity positions. The agenda for this call is I'm going to introduce Mark Reyes, who's the Vice President or Head of Product for BMO Global Asset Management. He's going to talk a bit about the operational side of the BMO funds that SIA manages. Then Jeremy Fehr is going to talk about the market outlook and what we've seen over the last few days, and again, looking forward. Then Paul Vendrinsky is going to talk about the actual portfolios, what they own, how they've done over the last week or so, and what you can expect going forward. And then I'm going to talk a bit about positioning for your clients, and maybe some questions that you can answer and address for your clients. If there are any questions, we're not going to open it up to verbal questions. However, on the webinar, there is a question tab. You feel free to type in your questions, and we'll try to get to that at the end. So as of now, I'm going to turn it over to Mark Reyes, and then we'll go from there. Thanks.
All right, thank you, Ted, and thank you everyone for taking the time to join today. Certainly a challenging environment, and that's one of the reasons why, we're so proud and happy to be working with SIA Wealth Management just for market conditions like these, where their unique approach with the equity action call and emotion-free investing, really helps advisors, clients get through these periods. And not have to deal with the emotional baggage of dealing with losses and getting in and out of the markets. And, if I look back to something like 2008, not that this is the same set of circumstances, but when you get such a market correction, there's people that stayed on the sidelines for 2009, 2010, 2011, and it got harder and harder to get back in. So working with a professional asset allocator, where SIA Wealth Management can help us really identify those re-entry points, is a great way to approach your practice, and it's a great opportunity now while in the red zone to reposition your portfolios. I wanted to take a moment and just touch on valuation, because I know a lot of the current users have been asking questions. Portfolios did go red on Friday, which basically means that the equity positions were sold off for short-term cash-like positions. Keep in mind, the way the fund accounting world works is that trades are reflected on a T+1 basis. You don't normally notice that in terms of day-to-day fund activity, because of course you're not generally trading such a large portion of the portfolio. And as well, when the markets were so highly volatile and have been so highly volatile, any trading throughout the day may have a material difference to market close on a given, highly moving market. So that's definitely what we saw on Monday, is the trades that were done on Friday were reflected in the NAVs on Monday, And because not all the trades were done right at market close, there was some dislocation between traded price and market price. I just want to assure everyone that that is market convention. That is how the street values mutual funds. If you think about it, doing things on the same day basis basically means your fund accounting group is, either global or working overnight because they don't get the trades till 5 or 6 o'clock at night. So I just wanted to assure everyone that there's no issues with the NAV calculation. It's just a reflection of volatility in the marketplace and the fact that we were turning over such a significant amount of the portfolio. So I'll park it there. I just wanted to give everyone assurance there isn't an issue with the NAVs and turn it back over. Thank you.
Perfect. Thanks, Mark. We appreciate everyone taking the time to come on today. It's certainly been an exciting market, none of it real good excitement. We are very happy to have such a strong partnership with BMO Global Asset Management. If you really think at the mechanics of what it takes to go to a cash position of 100% of the portfolio and all the moving parts behind it, I can assure you that it is not an easy task. And to have a great partner that believed in what we were doing, saw the progression we were making in the investment field is quite great, and we're very pleased with how it's working so far. We're going to be entering our 6th year in April in this partnership, so we'll have some 5-year numbers on our first 2 products, the Tactical Global Equity and the Tactical Global Bond. But first, before we get into the product updates, which Paul Vendrinsky, our portfolio manager, is going to provide, I'll go through where we're sitting today and how we got to where we're at. The first chart I want to take a look at is our equity action call. This has not changed since we moved to the red zone back on Thursday close, and then Friday was our trading day when we moved our equity positions to money market products. We continue to be in the red zone. This is directly straight down. If we look back to 2016 and 2008, and 2011, we can see that this is quite a substantial change coming right from the top of the green zone straight down without even a bump in the road. This is quite unprecedented, as we all know. The asset class rankings for the first update in the last 3 weeks, they have not changed since our update on March 12. We remain with our second level of analysis, bonds at the top, currency second, international, cash, U.S. equity and Canadian equity, and finally commodities at the bottom. Of note, which I mentioned on our March 13 update, was that international equity is holding up better than U.S. and Canadian equity. I even struggled to remember a time where international equity has been above U.S. and Canadian. So I think that's material, and it really speaks, I think, largely to the fact that the coronavirus ravaged through Asia first, and those markets have seen hopefully the worst of what the coronavirus can do, and they're starting to rebuild, and they've got obviously a lot further into it. What's about to happen in U.S. and Canada is yet to be determined. Obviously, we may have a substantial lead on it based on the fact that we got to see what happened in Asia. The first slide that I think is extremely material to us is that we really have a world that is a lot more like 2008 than 2011 and 2016. So if you think back to the red zone of 2011, this was just shortly after the 2009 bottom. We had a situation where central banks were getting together, where elected politicians were flying G7, G8, G20. Everyone was talking to each other. Everyone was coordinating efforts that synced together for the common good. The same thing happened in 2016, and for those of you who've been with SIA through that, we can speak to the Federal Reserve doing something unprecedented when they chose a weak U.S. dollar policy, when they had an opportunity where their economy was extremely strong, but the commodity-based world, the emerging markets-based world was extremely weak. They chose to devalue their currency and certainly helped the rest of the world. If we look at 2020, we don't have the same type of coordination globally as we might have had. We've seen political ideology come in, market infighting, even we've seen surprise announcements by Trump, surprise announcements by the European Union. We have a situation where the two I guess, number 2 and number 3 oil producers now, that the U.S. is a major producer since September of 2019, where they're not getting along as well. And now we have a price war with crude on top of a situation where we saw demand weaken with China, closing down and a lot of restrictions on travel. We saw 4 million barrels disappear from demand, and the subsequent response was quarreling with oversupply now hitting the market and crude getting slammed. The coronavirus remains as an unknown. We don't know what the effects are going to be in the United States, especially and in Canada. We can forecast based on what we've seen in Asia. We can forecast on Italy, Spain, and what's happened there and what's worked there. We just have to wait and see if the policies that have come out are really going to be beneficial, and we'll see that plateauing instead of that huge spike up that we expect, but we're too early on to know right now. So the risks of a red equity action call, there's been a lot of people calling in and going, hey, Jeremy, in 2016, we got surprised in a red equity action call, and that didn't work out for us. Again, for us to have that type of surprise, we're going to have to see better coordination between the ideologically different governments of the world, which are quite different from 2009, 2011, and 2016. And we're going to need to see that the Russians and OPEC are going to have to come to terms and stop their trade war, which is essentially for market share post-coronavirus crisis. So these two things are material for us to see at least a near-term bounce in the equity action call and stocks rebounding. So I feel the risk is substantially less today than it was in 2016, 2011, where we saw the equity action call go red and come up from there. I also have another slide here talking about market rates. We've seen the Fed and most of the developed world lowering them quite dramatically. So the world, as we know, is largely in debt. Both corporately, consumer, and governments have been piling on debt. In some cases at an unprecedented rate. We've got interest rates have already moved down and to date have had no effect, but certainly maybe alleviating some of the risk that governments, consumers, and corporations have on their balance sheets. The 2020 bear, this comes across as the fastest bear market in history. It was 21 days. So again, speaking to the elephant in the room, when our red equity action call came in, it seemed later than what our clients have seen at SIA Wealth and previously in 2016 and even 2011, and then before that with our SIA Charts community. And this really comes on the back of us staying very, very close. We stopped 2 times, very, very close to a red equity action call and bounced, and then the day of the red, we were seeing a 10% drop and a 13% drop. So the percentage down is larger. It can be 90% attributed to that single day. Generally speaking, what we've seen is we land in that 15% range, and I believe 17% was where we were in 2016 before we get a red equity action call. The one thing I would like to point out, even though we are in the red and there have been some drops already in the marketplace, we are sitting on money market positions for our equities across our funds. In the bottom right corner, we list what the returns are in the green zone, the yellow zone, and the red zone, and we can see both across the S&P 500 and the TSX Composite that in the green zone, the returns are very good. In the yellow zone, we quite often see positive returns, but the red zone has traditionally brought us significant downside even from here. So on average, 22% and change down. So risk still remains extremely high, and our position in money market is largely warranted. I wanted to take time to take a look at what happened in 2008. Our indicators started to decline. So this would be a more traditional bear market like we saw in 2000, like we saw in 2002, 2001, 2002, and what we saw in 2008, where we saw the large pools of capital anticipating the risk was rising and starting to move out of their equity positions and replacing them with alternative equity asset classes. This started in July of 2007. We moved into the red zone in January 2008. This is all highlighted on the chart there. So the market had only dropped about 12, 13% at that time. We saw a little bit higher than that, about 15% at that time. We did see a bounce in the market from there. It moved up again and then slowly declined into the large collapse that we saw starting in September of 2008 and really hammering down through October as well. So again, what we've seen traditionally in bear markets in the three previous, including 2008, was that money flows were anticipating that, large investors were anticipating the problem and started to move out, and we get a better catch on what it's like. If we look at the same chart, this is our SIA Market Equal Weight Index for 2020, we can see that the drop that we've had here is very, very similar to what we saw in September of 2008. The same amount of O's came into it. This just happened a lot faster. So the O's represented here, we were in the red zone, about 6 O's, 5 or 6 O's above where the bottom of that is, but we've reached that crisis. So we started hitting market top February 18th of 2020. We moved to the yellow zone on March 6th of 2020, and then the red zone very quickly thereafter on March 12th of 2020. What I've highlighted on this chart, and I apologize I didn't mention, I'm going to flip back a slide here. We see the yellow areas that are highlighted on this chart. The top yellow is the move down that we saw before we went into red, and then we saw the large collapse that is almost identical percentage point that we've seen in 2020, and then we had another drawdown from there. So there's about 28 O's of additional downside in there. I've highlighted it on this chart. If we're going to have the same level and size of correction as 2008, obviously I cannot guarantee that and don't know if it'll go that far. There is those three variables at play: government policy, the coronavirus outbreak, and energy policy between OPEC and Russia. These things could come in and help us out, but this is what we could be looking at. So again, coronavirus is just, in our opinion, has adjusted the order of events where we've seen the crisis show up faster. We're likely to see more volatility from here, but with earnings seasons coming out mid-April to the end of May, and especially with the retailers coming out in the middle part of May going forward, we still have potentially some bad news to come into the market. So the first chart I want to look at from an index level is the S&P 500. We've broken down here. We're still above the lows that we saw in 2018. So we're approaching our key support, and with today's activity, it would appear we may go below that. Key support is above 2328. The next level of support is that 2109, which takes us back to the highs or when the breakout happened post 2016 when we had the crisis there. And the first bullish chart move would be 2728 from here. So this will be a chart that we'll be updating on a current basis. It's going to adjust, especially with the big moves we're having these days. We'll keep updating those to you. But for now, it looks like we're going to hit another negative support level, or another support level will be taken out with today's activity, which opens the door for even more downside to that 2100 level. The TSX Composite, a similar chart. It has been hurt a little bit harder. Is that a function of some of the problems that we had pre-coronavirus, but largely probably based on our commodity, specifically energy dependence? We're approaching key support 11,721. Again, we're at risk of going through that support level today if we close where we're at. The next level of support is that 10,616, which would take us back really to some of those early breakout moments of 2009. So, this is key support for Canada that we're looking at right now, and a breakthrough of that gives us potential downside that would be even more material than what we've seen so far. The first bullish chart move that we're looking at, if we were to close above support, would be that 13,734 level, and we'll be watching to see that if it happens as well. International, which I had mentioned earlier, which is benefiting, we believe, from being first in on the crisis and have handled it, and we have a lot more information. Again, this is not a massive outperformance over U.S. and Canadian markets, but is ranking higher in our asset class rankings at this time. It has broken. This is our SIA International Equity Equal Weight Index, has broken through its uptrend. It is approaching key support at 24,541. Again, we won't know until tomorrow whether or not it breaks through this. The next level of support for that is 22,672, and the first bullish chart would be that 28,190. So we'll have to wait and see what tomorrow brings as far as international equity. One of the charts of the day, and it's almost incredible to look at the decline that crude has had, but again, with the lack of demand that's coming into economies that are largely shutting down to prevent the coronavirus outbreak from spiking and just plateauing instead, and the subsequent oil war between OPEC and the Russians, we've moved down through support levels, even lows seen in 2016. So our next level of support on crude goes back to 1999. We are looking at 24.44, $24.44 being the breakdown from here. We are currently trading below that level last time I looked before I got on the line here. So again, really unprecedented, and speaks to the desire for these countries to gain market share in a situation that is likely to see reducing demand in the near future, and then potentially reduce demand as we come out of recession on the back end of this coronavirus. A chart that I haven't updated recently, but I thought was very material to today's conversation, is high-grade copper. Copper is seen by many parties, including myself, as a global growth barometer. We can see that it broke down when it hit 252 here in March, and now is sitting at key support above $2.24. So as it sits today, it looks like it could break that down and go down to that 199 level. So we'll be testing, down to that 175 level range, could be tested over that. Again, this is not dissimilar to what we've seen in the Canadian chart, where that would put us well into the 2009 levels. So quite unprecedented. And again, we'll be watching this again for signs of potential bullishness, which could be a predecessor to an equity action call moving back to green. But as it sits today, very, very negative. The US dollar, Canadian dollar, this is clearly a position that disrupted us in 2016. I'll let Paul Vendrinsky speak about our holdings going forward, but the Tactical Global Equity Fund is the only one with a US dollar exposure at this time. It has worked for us in the near term since our money market call after the close on Thursday and execution on Friday. We are seeing it move up close to those 2016 levels. We're currently sitting at levels that are potentially going to see a breakout of the chart above that 146.29. We'll wait and see that. I did want to mention for those of you in the Tactical Global Equity Fund that we have shortened our USD CAD rules. So we are prepared to act faster on that call should we see a reversal, again, largely based on an intervention from the Federal Reserve or other parties, or including other parties. But we don't see any evidence of that at this time. So the US dollar appears to be strengthening dramatically. A breakout above that 146.29 could see that 155 range, 152 range tested in the near term. With that, I'm going to turn over the presentation to Paul Vendrinsky. He's going to go through the mandates that we have sub-advised with BMO Global Asset Management, and then after that, we'll do some questions.
Thanks a lot, Jeremy. And regarding to questions, type them in if you have any questions on some of the stuff Jeremy covered, or going forward, you can just type them in, and we'll go through those after. Thanks for joining us. Last time we did this call, the equity action call moved from green to yellow, and we kind of went over what was triggered immediately from that. And at the time, the only immediate changes were to one of the funds. But with this move recently here from the yellow to the red, had dramatic immediate effects on 4 of the 5 funds that we sub-advise for with BMO. So as Jeremy mentioned, because we're in the red zone, we're taking all equity risk out of all of those portfolios. But in the same time, we still want to find some kind of yield going forward. We're not sure how long we'll be in this situation, so we do want to see some returns. So we looked at a couple of short-term bond ETFs to include in these 2 portfolios. So I was just going to point these out real quick. The first one, ZST. This is the BMO Ultra Short-Term Bond ETF. So this is generally under 1 year short-term Canadian fixed income. So obviously this is the base currencies in Canadian dollar bonds. Right now it's sitting with a weighted average coupon at around that 2.76% and a duration of 0.5, so half a year here. So fairly short term to hopefully give us some kind of return going forward. And the other one we looked at too is the ZUS.U. Now this is the BMO Ultra Short Term US Bond ETF. Now for these holdings, this is what's going to give us exposure to the equivalent, but on the other side of the border. Shorter term, short duration, under 1 year US bonds, and similar coupon rates, but with the US dollar. On the next slide, I'm going to show you exactly what happened to the individual funds and how this move to the red zone affected it. So for the BMO Tactical Global Asset Allocation ETF fund, and if you remember from the last call, if you were on it, we shifted from 40% fixed income to 60, and then from 60% equity to the 40. So that 40% of the equity exposure has been sold and currently owns that ZST. The other 60% is currently still in fixed income. We are making some changes within that universe that I can't report quite yet because we're in the midst of that, but still it's a 60% fixed income and 40% short-term bonds, as you can see here. And that ZST also made way into the BMO SIA Focus Canadian Equity ETF Fund, as well as the BMO SIA Focus North American Equity ETF Fund. Not much changed in those portfolios while we were in the yellow, but obviously this shift down, now we've moved completely out of equity and essentially 100% holdings in this short-term bond. The only exception outside of those three is the BMO Tactical Global Equity ETF Fund. As Jeremy mentioned, we currently own the ZUS.U, so that fund actually has the exposure to the U.S. Short-term bond. So it really gives investors an opportunity to take on currency risk if inclined. We are seeing a lot of strengthening in the U.S. dollar, but as Jeremy mentioned too, if that strength started to turn and we saw some strength come into Canada, we have the ability in that fund to move then to that ZST. So, but at this point now, you really have an opportunity to be on either side of the border, depending on which fund you are looking at. The next slide, just is giving a snapshot of the various funds' performance. This is as of Monday's close, and the highlight I wanted to point out is really the year-to-date column. With this move into the red zone and taking away from equity risk, you can already see some of the difference between what we're happily missing out on, including, and of course this doesn't include today's move down further, but this is our risk-off approach, and you can already see the differential. It's a shame that a lot of these are in the negatives year-to-date, even after such a strong January and start of February. But going forward, obviously we're trying to not participate in any further downside. And until we do see that turn and move all the way back into the green zone, we're going to be holding those short-term bonds in our 5 equity funds. And as I mentioned, in the asset allocation fund and the bond fund, there are some shifts taking place within the bond holdings, but until we see that move back up, we're not going to have any exposure to equities whatsoever. And with that, I just wanted to give that quick summary on the market returns. I'm going to pass it back to Ted, who will kind of go over some of the talking points to help you and your clients, but I'm always available for any questions. Thank you.
Thanks, Paul. And so, as most of the advisors here understand, Jeremy gave a bit of a concise outlook on what we're seeing in the markets. We have, out of the 5 mandates we run for BMO, we have 0 equity exposure, and that's really the important thing. So we have a lot of clients that the first title of the slide presentation was "What Now?" So a lot of clients have come to us and asked what are their options now. There's a couple of positions to think about and where these funds might make sense. If you have cash on hand, happily you might have been able to raise cash over the last little while. We are getting a lot of advisors looking at allocating some of that cash into some of these funds. So essentially you're getting the same type of cash equivalent However, it is inside of an equity fund, and you do have the opportunity to benefit from using SIA signals for when we get back into the market. One of the biggest issues we have is timing markets with a lot of advisors, and how do you re-enter it? Think back about 2009, bottom of the market was March. What is the opportunity going forward? Were you able to participate in March, or were your clients resistant to that? So part of the question is, how do you position this? Is if you have cash on your books, and your dealer may be giving you some issue because you have too much cash. We've heard of that situation. Potentially own some of our funds, which would show up as an equity, yet you'd still have that ability to protect your clients from any further downside. Second, if you're looking to re-enter the markets, SIA gives you a very good rules-based process on when that happens, and we will get fully invested once that equity action call goes from the red through the yellow into the green zone, and then at that point we will get fully invested again. And the other side is if your clients are still fearful, and if you also think that the current situation can get worse, but you don't want to sell equity positions and go to GICs, because the point is then it becomes very difficult to get those GIC positions back into equities when this blows over. We can do that for you, and that's a big benefit of using these types of strategies. You know, our largest fund with BMO is our asset allocation fund, our global balance fund. It's been one of the top funds in the category, and we hit a 5-year number this year. It's a great way. Right now, it has zero equity exposure for a global tactical balance fund. But when we get back in the green zone, we'll max out at that 60% equity exposure again. A lot of people see the opportunity in the USD. Our global tactical equity ETF fund is a fantastic opportunity to get that exposure in the USD. However, after 2016, a number of people were a bit gun shy about that. So our focused funds are all in Canadian dollars. So a good opportunity might be to split the difference, have some in our North American or Canadian focus fund, depending on where you see the opportunity, and some allocation into the global equity fund, where you can get a bit more US dollar exposure. We've seen a huge jump today, also over the last couple of days, in USD versus CAD. So that fund has been performing quite well. We expect a lot of opportunity, and we do think that any crisis, is basically an opportunity waiting to happen. So we do want to be there and supportive of our clients. Talk to them about having a tactical asset allocation sleeve. This is exactly where SIA fits the bill. A lot of times you're going to hold positions, and if they've already gone down 20-30%, you might hold them on down and then wait till they come back up. But a lot of advisors are starting to build a tactical sleeve that's at least a 15 to 25% part of their book that has that ability to go to cash, to overweight US, to overweight Canada or global, depending on the situation. That's exactly where SIA finds themselves. So with that, I'm going to open it up to questions. And if anyone has any questions, feel free to type it in. We got a couple questions to answer. One is, there are still stocks that have strength, such as Clorox and Good Food. Why not own a collection of such stocks? Yes, there are always stocks with strength. Our system doesn't stop because we go in the red zone, so we still rank all of the stocks against each other. But our rules are overarching, so we will not own any of those positions right now. We do, anyone who uses SIA charts, feel free to purchase where the strength is. We still recommend that on an individual basis, but our broad recommendation is not to own positions, stock positions at this time. So
I'll jump in on that as well, Ted.
Yeah.
Just all of our testing really comes back, and all our real world experiences now. We're into our 21st year doing this. Is that any gains that you may render during short portions of a bear market will be taken away when that bear market hits that complete and total capitulation. So it's a very, very difficult strategy. We know that the largest updates or upswings in the market happen during bears, but the reason why we don't try to play even those short-term bounces in the market is that the timing of it is so hard to get that if you miss it even by a little bit, you're going to have all those gains erased really, really quickly. So we don't play that game. What we're doing right now is risk off. We want to ensure to minimize the damage that happens to the portfolio. You can see from our numbers here, we do have some damage in the portfolios, but these damages are nothing like what it took in 2008. When you look back at that, most Canadians had to work another 4 years to reach their retirement goals. It took, in some cases, 5, 6, 7 years to high watermark. When you've got downswings that are, in the teens, you can gain that back very quickly and get into positive territory. So we don't want to put that at risk just to try to be short-term timers.
Yeah. And another question I keep on getting is, right, going from the green through the yellow to the red happened very fast, and a lot of people feel that it was a bit delayed. But how does it look potentially going up from red back into green? What happens if we do get a pop? I know it's not going to be the same as January 2019, but Jeremy, you might want to answer this. What happens if market starts to rally? How responsive is the SIA equity action call?
Yeah, and traditionally, very responsive. If you look back when we did the 2000, 2001, 2002, 2008, 2011, and even in 2016, our downside was measured in the currency, not on the swing back. So even when the red equity action call gets a whipsaw to it, which we saw in 11 and 16, that's generally measured in small percentages. We did not catch the bottom in 2008. We gave that back, but the amount of downside that we prevented before that was quite significant. So we don't see this as any different. We've got most of our funds are positioned in Canadian dollar currency, so that currency risk is not there. If you're in the tactical global equity product, we've shortened the US dollar call, and we do have an alternative. We do have a global. Back then, we have to only own, there's only a few currency ETFs we can own. There is another global one that we can get involved with. So it's fighting for position in here as well. The US dollar is just a standout at this time relative to other currencies. So we're there. But again, that's been shortened up. So we don't see it as tremendous risk in it. And historically, outside of us getting the 2016 currency problem, would have really largely been a non-event for the performance for clients going into it. So take that under thought when you're thinking about trying to time it on your own instead of us doing it for you.
Okay. Another question came in. This is for Paul Vendrinsky. Can you comment on the current allocation of the bond fund? So Paul, not on any of the trades going on, but kind of where the bond fund is allocated kind of previous to that.
Yeah. No big changes as far as the big picture view. When we went to the 40-60% in the asset allocation and the bond fund on its own, currently sitting heavily weighted to Canadian bonds. It's 75% now Canadian, 25% US. But like I said, there is going to be some shifting within those allocations, but that's the broad allocations currently.
Okay. I think kind of the point is that we're still in the mid. We haven't gone to the long side yet, and obviously we've seen a big bounce up in that side of it. But we're still owning the same types of bonds that we've been owning for the last while, and that's what it's allowed this bond fund, which hits its 5-year number, to be one of the top bond funds in its peer group in Canada. Now, one of the things I will mention about the bond fund is we are only purchasing investment grade bonds. That's quite an important statement when you talk about bond funds, and when we get compared to a lot of peers, we are an investment grade bond fund only. So that's only the fixed income ETFs that we're purchasing are only buying investment grade bond funds, and that ends up being quite one of the big selling features. We've been doing a lot of work on correlations with other bond funds, and we tend to be negatively correlated with some of the larger bond funds, and that ends up being quite a good opportunity. So I will also have a question with the amount of government debt that will need to be taken here. Are you comfortable in a bond fund versus T-bills? Paul or Jeremy?
And I think further to, we're still relative strength ranking our alternatives. So we could look at anything from a 30-year government or corporate to cash or cash equivalent. That's still considered fixed income, something like we own in most of the funds. So we will see some rotation, and if the higher ranking on a relative strength basis points us down the yield curve, we'll flow there based on the rules. So we'll see these changes. We are seeing some changes out of certain asset classes within the bond universe, but it does have also the ability to not only shift us around on credit quality, but down the yield curve too, if we start seeing more of that. But we are currently holding and holding strength in the bond universe that we're tracking.
Okay. So the next question was, we're currently owning short-term bonds. Are we comfortable with government bonds versus T-bills?
Within the ZST, it does include T-bills, government bonds, and some shorter-term corporates. That's within the universe.
Yeah, I think the point there is a short duration, and I think yes, there is a lot of government debt that's going to be put on the books, but the fact is that we own things that are less than half a year, so it's all within, that's going to come to maturity within the next 6 months. So that's quite an important aspect for us. Okay, so if there are no questions, I'm going to wrap it up. What we want to kind of highlight again, out of the 5 mandates we run with BMO, even though they are all based on relative strength, they all have different performance characteristics. And right now, it is a great way to get exposure, cash exposure that shows up as an equity fund. And it is also a fantastic way to get an opportunity to have a process that will help you get back into the markets when this goes over. One thing is obvious from the last week is the emotional roller coaster that we all put ourselves through, our clients put ourselves through from a personal and a professional level. And this is one of the things that SIA really does help with, is helps avoid and takes that emotion out of it. I can tell personally from myself, I've been riding the roller coaster of, do we sell everything? Is it a bad time to sell everything? Is it a great time to sell everything? Today, it looks like it's a good time to be in cash, but that could obviously change. And as such, we will change. One of the things that SIA is not, is we are not a predictor. We will not predict what happens. We are following the money flow, and that by definition is always a bit of a lagging indicator. We always try to keep as close as possible, and that could be seen in what happened last week. But the point is, we want to actually be very decisive once our signals come through. But please don't think we're ever going to be able to get out or get in before things start to move, because we are following price movement and money flow. And just to wrap up the different funds, the BMO Tactical Global Equity Fund is all in US dollars right now. So that is to be viewed as an opportunity in light of what we've seen the US dollar strengthen over the last little while. The Canadian focused fund and the North American focused fund are all in Canadian. So that is far more of a safe haven. You won't see much of a movement in the NAV over the next, as long as we're in the red zone. Our tactical balanced fund has 60%. Our tactical asset allocation fund has 60% in our global bond fund, which is still in the mid duration and corporate range, and it has a mix between Canada and US, overweighting Canada at this point. And then the other 40% is short-term Canadian bonds. And then the bond fund is our last one, which is what we've already mentioned as one of the top of this peer group. So we're very pleased with the diverse lineup. We do have mutual funds and ETFs available. So if anyone has any questions, on trading, please reach out to us or BMO and make sure you get all your questions answered. But we're here to help. And thanks everyone for your time. And if there's any other questions, feel free to reach out afterwards. But thanks again, and best of luck for everyone.
Thank you, everyone.